Well, welcome back. Now we'll look where markets ended the week after we did get some key economic data on Friday, giving us the first read on fourth quarter GDP, coming in at 1.4%. That was far below the range of expectations, which called for growth of 3%. But remember, we had a 43-day government shutdown during the quarter. We also got the Federal Reserve's preferred measure of inflation. The December PCE index came in slightly hotter than expected, at up 0.4% compared to expectations of 0.3%. Joining me now is UBS's Senior Portfolio Manager, Jason Katz. Jason, great to have you this weekend. We so appreciate
Thanks,
your
Maria.
time.
Great to be here.
And let me kick it off right there. What is your assessment of the economic data that we saw this Friday?
Yeah, I mean, markets reacting to a GDP miss, frankly, is misguided. 1.4% U.S. economic growth was largely predicated, as you said, on that 43-day government shutdown. You know, these furloughed workers are going to come back to work, so the long-term effect will be minimal. Then you get to the core PCE. It more or less held steady at 3%, but it really complicates the rapid cut narrative. In our view, the porridge may not be just perfect, but is good enough in our view for at least one, if not two rate cuts. And the economy is in pretty good shape. We're at full employment, 4.3% unemployment. We have tax cuts in the latter part of the year. Investments in AI should drive growth. So it's no wonder the cyclical parts of this market are doing really well.
Great points all around, Jason. There are still these market fears around AI, and they may have eased the last couple of days, but it's been a rocky month for technology, and investors are questioning whether massive spending will actually pay off. As, of course, NVIDIA is close to finalizing that $30 billion investment into OpenAI as part of that massive new funding round. It could bring in more than $100 billion. NVIDIA is also reporting earnings in this upcoming week on Wednesday. I wonder if that's going to set the tone. What are your thoughts on the AI disruption trade that we've been watching?
$1 trillion of market cap have been wiped out. And to your point, there's two main drivers. Fear that AI will make everything either the success of an iPhone or the failure of a BlackBerry. And that's just intellectually lazy. The CEOs that I talk to, they're not talking about AI replacing their business. They're talking about it being a margin enhancer. And then with respect to CapEx, it's worth noting $700 billion from the hyperscalers is 4 times the level of last year. It is absorbing the vast majority of their cash flow. But these companies don't necessarily have to spend or survive, but they do in order to thrive. You think about Amazon back in the day, pivoting to AWS and that big spend, and everyone so worried about it. Well, that paid off in spades. So the bottom line is selling first and asking questions later, and that's what's happening with software and wealth managers and logistics. I mean, that is a foolhardy strategy. Winners will combine human judgment and leverage AI, Maria.
So you think maybe there's opportunity here, Jason? How do you want to be positioned for 2026 then, in terms of your portfolio?
Well, I think you need to continue to lean into the cyclical trade. If you have an economy that is going to run relatively hot, and I do believe with the midterms and the not too distant future, the focus, and I understand geopolitics are front and center, but the focus will turn to affordability issues, portable mortgages, capping perhaps interest rates on credit cards. Whatever the case may be, the focus will turn inward, and I think the economy will do just fine. That's why the cyclical parts of this market that are still exceedingly cheap continue to rally.
Yeah, and of course, the cyclical names are also responding to a very good macro story, which is what you just talked about a moment ago. Do you also have any thoughts on what we've seen in metals? Because gold is up in the double digits year to date. You've also got money having moved into silver and copper, even if silver rolled over in the last couple of weeks.
Yeah, I get concerned about the memification of metals. We're constructive on gold in the long run, but I am concerned that the same crowd that clamored over meme stocks and then pivoted to options and then went into the world of Kalshi, abandoning Bitcoin, going to gold. I think there's a little bit of too much fast money in the short run there, and I'd be a little bit careful. Long term, I think the setup for gold still is constructive.
All right, we will leave it there. Jason, great to talk with you. We so appreciate your time. Thank you.
Thank you, Maria.
All right, see you soon.